Hi, everyone. For those of you who I haven't had a chance to meet yet, my name is Tony Yang. I run the growth team here at Mucker, which basically means I get to work with a lot of very smart and driven founders of startups, and I help guide them on their go-to-market and growth strategies. But really, the star of today's show is our friend Debbie Rosler from Burkland. We work with Burkland, and many of our portfolio companies do as well. And we've invited her to talk about this topic of Finance 101 for startups. So, Debbie, thanks for joining us. Super excited to hear what you have to share. And the floor is yours.
Great. Thanks so much, Tony, and really excited to be here today. As Tony mentions, I work at Burkland Associates. I work as a fractional CFO, and I've been with the firm for 10 years. A fractional CFO means that I provide support to several startups at the same time on a part-time basis. My expertise is personally working with SaaS companies. As a firm, Burkland works with over 800 startups focused on venture-backed startups across a range of industries. SaaS is one of the areas, but we also work with healthcare, consumer, and fintech companies, among other industries as well. So to kick it off, I'm going to dive right in and walk through the agenda. So today I'm going to be talking about finance best practices specifically targeted at early stage companies, and specifically looking at like the earliest stage, like seed, pre-seed stage companies is sort of where a lot of this is going to be focused. I'm going to kick off by talking about why it's important to focus on finance from the very beginning, talk a little bit about how the types of finance support that early stage startups need and how that evolves as startups grow from the seed up until the Series A and then Series B stages, the types of people that provide the support and how you think about bringing that support in. Talk about financial systems, HR and payroll, banking best practices at those stages, the types of financial controls you're going to want to put in place, financial reporting that you'll want to have for yourself as well as for any of your outside investors, making sure that you're compliant with corporate tax requirements, and then what it takes to make sure that you're set up in a good way that you're able to do due diligence as the company goes into various transactions over time. And as Tony mentioned, please, feel free to ask questions as we go, and I'm happy to do that. And I'll also leave some time at the end for Q&A as well. So to start off and set the stage, why is it that this is important? Why should you care? And this has some quotes from various people in terms of why it matters to get it right from the first stage. What I would say that we see quite a bit at Burkland is that a lot of startups at the earliest stage, they just got funded. They're very, they may have a limited amount of cash. They're very, very focused on, extending the runway as long as possible. And so sometimes they'll take actions. They'll say, what can we do in the least expensive way possible? They'll try to start doing finance and accounting on their own. And what I see more often than not is that people that don't have that expertise, that background in finance and accounting, not to mention that they're focusing on starting a business and developing products and getting out and selling, they don't have the time to focus on doing it right. And so they end up making a lot of mistakes. And what ends up happening is that the cost of going back and cleaning up those mistakes is significantly more expensive than getting finance and accounting right from the very beginning. So our recommendation is, day one, you're starting your business, bring in outside support immediately. It can be very cost effective. You can find firms like Burkland and others that are able to provide support just on an as needed basis. You can pay hourly, you can pay small fixed fees, you get it right from the start, and then you don't end up with this problem of having to do the cleanup after the fact. And not only do you have issues, so that's one of the pitfalls we see as companies that are getting it wrong and then end up having to spend a lot of money cleaning it up. But there's a lot other pitfalls that companies can fall into if they don't get it right in the first place. Certainly from the standpoint of taxes, there can be really significant penalties if you don't get the taxes right. You can run into issues with financial controls, unfortunately, leading to fraud and embezzlement. That's something that's unfortunately rampant these days. Having people in to support and make sure that you're not subject to financial fraud is really important. And then investors also have an expectation that the financials are right. And I've unfortunately seen, occasions where because startups didn't have their finance systems set up in an effective way, investors lost confidence, and that caused issues in being able to raise their next round. So even though the underlying business was really solid, investors didn't have confidence in the business because they didn't think that they had their systems set up in a good way. So this is just sort of sets the stage for why this matters, why it's important.
Hey, Debbie, when
Yeah.
you say you recommend getting help starting from day one, do you literally mean day one, such as when a founder incorporates their company, even before they receive any funding, start to get revenue?
Yeah, I'd say as soon as you start having transactions, okay, certainly by the point that you've raised any funding, for
Mhm.
sure there. We do have some clients that will incorporate and start with us. At that point, there may not even be any transactions. But once you get to the point that you actually have capital in a house and you're spending it on payroll or other expenses, at that point, that's the point where you want to start tracking from day one. And the key thing with that is that you set this up. It may only be a few transactions here or there, but getting it in the financial systems from the very beginning is the right way to go.
Great.
Thanks, Tony. Okay. So this first slide sort of outlines the types of financial and accounting support that early stage startups need. And this is laid out sort of across the stage of the business. So you can see the starting point, we're looking at sort of pre-seed, seed stage, and then how that evolves as you get sort of later into the company's maturity, as you get into Series B and beyond. And this all has sort of a lens of a venture-backed company. I know some of you may not be on that path for venture back. So just think about it as sort of maturity based as you go from sort of pre-seed seed sort of conceptual stage up to sort of as you're getting towards Series A, you're getting sort of starting to get some revenue traction and building product market fit and sort of and beyond. You can sort of think of it in that same lens as well. At the pre-seed and seed stage, the first thing that you're looking to get set up is the accounting and tax. And the topics that are sort of outlined in this section is sort of the key focus of a lot of our conversation today, because this Finance 101 is focused on sort of pre-seed, seed stage companies. So at that stage, you're looking at setting up your initial accounting practices, ideally putting in place accrual-based accounting, setting up your base level financial systems. I'll talk a little bit in a couple slides about some of the systems you might want to consider there, putting in place HR and payroll, getting set up with banking, making sure you have financial controls, have tax compliance. All of those type of things are sort of the first thing that you're looking to do. As your company is growing and evolving, you're getting closer to a Series A stage. That's the time that most companies are starting to look at putting in place some of the initial strategic finance capabilities. So building out their first long-range financial model, 3 to 5 year model, understanding their revenue model, their unit economics. Maybe they're starting to generate some revenue at this point, and so you're starting to build out some of your financial metrics. The type of metrics you're going to be looking at might vary by industry. And then starting to think about getting into a Series A raise. So for a lot of venture-backed companies, the Series A will be the first time that they have a priced round. And so then they're starting to get a little more detailed into understanding cap tables and dilution and what that all means. So that's sort of the types of capabilities you're looking at sort of as you're getting into closer to a Series A. And then once you raise a Series A, you start diving in deeper into some of your what we call financial planning and analysis. So this is some of the additional strategic finance areas where you're looking at not only having a long range financial model, but having sort of regularly updated forecasts that you're looking at, sort of understanding what does the business look like within the year and what does your cash runway look like. Scenario planning is another thing that's been really important in recent years. Since COVID, there's just been a lot of volatility in the startup landscape. You have COVID, you have this challenging fundraise landscape that we've had over the past few years. And in the context of that, startups have faced a lot of volatility and uncertainty. And it's been really smart for even earlier stage companies to put in place a variety of scenario plans so that depending on whether they're facing an upside or a downside scenario relative to what they originally thought they were going to be, they have plans in place to quickly pivot and change their plans, whether it be hiring more aggressively or pulling back on hiring to extend the runway. you know, at this stage, you might be starting to look at sort of getting into some more detailed financial metrics. You might be around the point that you're hiring some of your first sales hires and need to think about sales compensation structures, which gets into sort of metrics heavy views of how you're going to have incentive compensation to pay your sales team. And then getting closer to planning for a Series B fundraise as well. And then once you get into Series B and beyond, that's where you're really starting to scale your strategic finance capabilities. So in there, you have much more robust revenue, starting to have detailed financial metrics analysis, financial intelligence systems you might be putting in place. At this point, you might be looking at sort of switching off of your base level financial system into a more robust enterprise level financial system. Some companies could be looking at M&A opportunities, whether it be selling the business or acquiring other companies, expanding internationally can be a thing at this point. And then another thing is preparing for a financial audit. So what we do recommend from the very beginning is to put in place accounting practices that set you up to be in a good shape once you get to an audit. But the reality is that in order to do a financial audit, which a lot of companies tend to do in the Series B or C stage, there's some extra level of accounting rigor that's required to get there. And sort of getting over that hump can be, a pretty significant thing. Doing a financial audit is usually not something you do at the very earliest stage because it can cost tens of thousands of dollars. It's not cost effective when you're not certain yet if where the business is going to go, if you have product market fit. But once you sort of get to the Series C stage, around then you're at the point that you're scaling, the business is established and starting to grow. And so that's often the time that investors like to see an audit. And so that's something that you'll be looking at that stage. So any questions on this slide? Okay, great. Okay, so that first slide talked about the
Actually,
type of...
Debbie, there is one that just came in.
Okay.
Question about the pre-seed and seed stage phase. Why do companies in that stage need accrual accounting as opposed to cash?
Yeah, so it's fundamentally a best practice to put that in place. It's something that investors expect to see. And I think it's particularly important for certain industries. Having that from the very beginning is really important. So if you're a SaaS company, once you start getting into revenue, understanding the way that a lot of SaaS companies work is that you'll have a contract that pays annually in advance. And investors from an accounting standpoint don't want to see you recognizing that full revenue up front because you haven't delivered the services. That's going to be delivered over the course of the year. And so if you do what's called cash-based accounting and recognize that revenue all up front, that sort of doesn't tell the true story. And investors sort of have an expectation that you're going to be doing that correctly. And so the reason you want to do it right from the front is, I've had many clients that were doing cash-based accounting for SaaS companies from the very beginning. And then but investors expected to see that accrual. And again, it's one of those cleanup questions that the time required to go back and get that right was substantially much more expensive than just doing accrual accounting correctly from the very beginning. So it's just sort of a cost-effective thing that you get it right there. And then the other thing I'd say is that if you're a product-based company, accrual accounting is really important so that you're matching the revenues you're collecting from a product sale with the cost of manufacturing it. And that can be fairly complicated, but if you're not able to correctly map those together, you don't really have a good understanding of the business's unit economics. And that's something that investors really expect to see. So again, this is one of those things that because you're a venture-backed company, accrual accounting is very, very important from the very beginning. If you're a bootstrap company, you're not looking for outside funding, maybe you can get by with cash-based accounting for a little longer, but if you're looking to bring in outside investors, that's just sort of a bar that investors expect to see.
Great, thank you.
Sure. Okay, so like I said, last slide talked about the types of support that startups need. This next slide talks about who it is, the types of people that actually provide the support. It shows the different roles of the people. So at the base level, you have the bookkeepers, and those are the folks that are responsible for the day-to-day accounting. They categorize daily transactions, manage client invoicing, accounts receivable, accounts payable. They're generally the first support that you're going to need from the earliest stage of starting your company. So when I talk about, Tony asked, do you need it literally from day one? And I said, yes. That's the person that you're hiring from the beginning. And it's the least expensive role, most cost effective. So that's the person that's going to initially set you up with, QuickBooks Online or whatever the base level accounting system that you're doing, sort of get that all set up at the very early stages. Controllers are the next level of support. These folks are accountants that often have what's called a CPA, and they have expertise in what's called GAAP accounting. So GAAP stands for generally accepted accounting principles, and that's the level of accounting you need to be able to sort of pass an audit. It's accrual based accounting, but it has very sort of strict standards in terms of how you're supposed to be doing the accounting, and the controllers are the people that are experts at understanding how to do this. Controllers can oversee the bookkeeper. They can also help with setting up more complicated accounting practices. So like I mentioned, it's good for SaaS companies to put in place accrual accounting from the very beginning. It may make sense, depending on the complexity of your revenue model, to have a controller come in, establish the practices. You may have the bookkeeper sort of doing it day to day, but the controller may be the one that actually sets up the initial practices. Similarly, if you're a physical goods based company doing manufacturing, a controller might be someone that would come in and set up cost accounting practices. And then they also are really good at helping to implement more complicated financial systems. So maybe you start with the QuickBooks, but want to evolve to a NetSuite, for example, over time, and controller is someone that would be helpful to sort of put that in place. CFOs are the next level up. They're responsible for overseeing both the finance and the accounting functions. So everything that we talked about in accounting, the CFO will be overseeing, not necessarily hands-on doing themselves, but overseeing all that work. And then on top of that, on the finance side, the CFO and or people on their finance team help to establish financial modeling and forecasting processes. They help to develop KPIs, support fundraising and strategic finance. Okay.
Hey, Debbie, do you, I really like that previous slide because it lays out the different areas that a startup or founder should focus on depending on which stage they are at. Do you have a similar view or recommendation for this kind of role in terms of help that a founder would need at each stage?
Yeah, it's actually glad that you asked, because that's what we're looking at on the next slide.
So
perfect. Very timely question. So yeah, so this slide sort of provides sort of a visual view of how you might think about staffing this function. And this is, it's not a one size fits all, so it can vary by company, it can vary by industry, but just to give you a sense of what this looks like, what often makes sense for startups is that initially they look at bringing in the support they need initially on an outsourced basis. And the reason that this often makes sense is because the level of support you need at this early stage is limited. And so to go out and hire a full-time employee doesn't make sense. And so you can do an outsourced fractional model, part-time, pay people on an hourly or a specific fixed fee basis to do the work initially. And then as you grow and scale, eventually you looked at bringing in-house. And sort of the rule of thumb that I always sort of talk with my clients about is that once any role is at 2 days a week to 2.5 days a week, you're getting to the point that it actually makes sense to, hire in-house and bring in a full-time support, because from a cost standpoint, it's just more cost effective. But where you can see that this sort of lays out sort of a potential staffing model. This sort of has applied, I'd say, to a lot of the SaaS companies I've worked with. It can be different among different industries, but laying out sort of by sort of number of employees at the company, what a progression might look like. And what you see is sort of at that earliest stage when you're 1 to 15 employees, like I mentioned originally, that first hire is definitely the bookkeeper accountant. So you're definitely going to want that at the earliest stage. You may be thinking about a project-based controller at that point. So depending on the types of needs you have, if you're a physical goods company, you need to put in place the cost accounting, like I managed. That's where you might be bringing in a controller, maybe not on an ongoing basis, but at least to get things set up. It's possible that there's sometimes that you might be looking at a part-time fractional CFO at the earliest stage too. A lot of times a little later, but so for example, I've worked at, really early seed stage companies because they had international subsidiaries from the very beginning. And so that adds an extra layer of complexity. So they needed that CFO support from day one. So it can vary, but certainly the foundation at that early stage is starting with the bookkeeping and accounting. As you scale a little more, 10 to 30 people, maybe getting towards a Series A, that's around the time that you're looking at, bringing in a CFO, continue with the bookkeeping and accounting. It's possible sometimes at that stage that you may actually be looking, the needs for accounting at that point could be getting to the point that you may actually be looking at starting to hire in-house for there. And what you see there is that a lot of times the first accounting hire, bookkeeping accounting hire, tends to be the folks that are responsible for client invoicing, paying bills. So if you're a company that has a high level of transactions and needs a lot of hands-on support for that, that's the point at which you might be thinking to bring in sort of in-house accounting support. Traditionally, those first hires used to be sort of a lot of times what was sort of like the office manager role, that someone would sort of be managing the office as well as sort of doing some of those roles. So they might not be a CPA or a really experienced accountant, but they'd be able to do a lot of those sort of basic bookkeeping capabilities, even though they're not necessarily trained accountants. That sort of shifted in today's place where there's often not office managers, not offices, physical offices anymore. So that role is sort of shifted around. But regardless of that, often that's the first sort of full-time in-house hire. And
So
then
actually, sorry to
what
interrupt. That was actually a question that came in, which was, how important is it to have a controller with a CPA as opposed to someone who just, has some background in finance?
Yeah, I don't know that a CPA degree per se is critical, but you definitely need someone who, from a controller perspective, like so for that early stage, setting up a financial system, you definitely don't need a CPA for that. What you do need is someone that understands generally accepted accounting principles, which is something that you learn as a CPA. So the CPA degree, to get that designation, you have to pass a really, really significant test. But there's, in order to be able to pass that test, there's lots of classes you need to take. And, those classes teach you a lot about GAAP. So the CPA is just a proof that that you were able to pass the test and do that. It doesn't mean that someone can't know those same capabilities without it. I will say that I think the majority of, or maybe possibly all of Burkland controllers do have a CPA, but again, I don't think it's a pre-requirement. It's just something that helps you understand that capability is there. I will tell you that as you sort of head towards, as the company evolves more and more, and once you get to being a public company, I think probably most controllers would probably have a CPA, but I don't think in and of itself that's a requirement. So talking a little bit more about the progression as you get sort of, maybe towards the 25 to 49 people, which might be getting towards a later Series A, Series B stage, at that point, you're probably still working with a fractional CFO. You may be starting to think about bringing in a controller on a more regular basis because you may be looking at getting closer to that audit point and making sure your financials are up to snuff so that you're ready to be able to pass an audit. And then once you get to sort of the 50 plus employees, which might be Series B or a little later, this is the point where you're sort of starting to think about transitioning most of your roles in-house. So you may still have some of the fractional support or some of the roles may be starting to come in-house. And then, by the time you're sort of Series C, late Series C, 100 employees, that's when you're probably going to have most of your team in-house. And I know from like sort of a Burkland standpoint, like, we work with companies, across all this span. And what we'll see is that, we do have some clients that are Series C that we've been with for a long time. But usually by that point, they have a full in-house team and we'll just be doing advisory support or, extra add-on support that they need sort of as they're staffing up. But really at that point, it's, you're looking at a pretty robust finance need where you'll start building out, full teams of accountants and finance people to support the full finance function.
So Debbie, outside of this slide showing the progression of a startup in terms of number of employees within a company, what are the considerations that a founder needs to take when thinking about possibly bringing that function in-house versus just continuing to use an outside resource?
Yeah. I mean, I think a lot of it comes down to a cost equation fundamentally. So it's, and that equation is dependent on sort of how much support do you need. And then that'll determine, if you're looking at something that, someone's working for you half a day a week, and even though, the bill rate you pay a consultant's going to certainly be higher than the equivalent salary for an in-house person, but still it's fundamentally more cost effective. What you'll see where some startups will go wrong is that they'll want to hire in-house from the very beginning, and they'll hire one head, but the reality across the finance accounting function is that there's like I said on this last slide, there's different levels of support needed. If you only hire one person, there's maybe just a little bit of CFO support, but that's sort of the most sophisticated, requirement needed. So what'll happen is someone will hire a CFO to do all three of these, but then you're overpaying because a CFO salary is a lot higher than a bookkeeper. And so, even though, yeah, you're not paying the same bill rate as you might pay to a CFO, but you're hiring for all of the support. So let's say you have a full day worth of support needs, but only, a full week, full 40 hours a week worth of support needs, but if only, half a day of that is the CFO work, but then you're paying for a full-time CFO, doesn't make sense. So what does make sense is to bring in the right level of support, pay for what you need for each level of service. And then once the economics work to the point that it starts making more sense to bring in-house, that's when you should start thinking about doing that.
Great, thank you.
Okay. So this next slide starts getting into specifically some of our finance system recommendations. So, at the earliest stage, what financial systems do you want to put in place? Usually the first system that companies will implement is accounting software. QuickBooks Online is a great tool. It's very cost effective, integrates well with outside apps and services. Probably 85 to 90% of Burkland clients are on QuickBooks Online. It's a great tool that works across many, many startups. It does have some limitations. So some of the things that can be challenging with QuickBooks Online are, number one, that they don't have the ability to do consolidation of multiple subsidiaries. So if you're a company that has, say a US, parent company, and then you have a subsidiary in India, you need to have two separate instances of financial systems. You can't actually pull it all together in one. And that's not ideal, but it's something that you can sort of manage for a period of time because QuickBooks is so cost effective. Another sort of aspect is, physical goods companies, QuickBooks Online doesn't have good tools for managing inventory and costs and manufacturing and, doing cost accounting. There are apps that you can add on that integrate well with it, but again, it's not optimal. And so because of that, startups start looking at sort of potentially evolving to sort of the next level systems. NetSuite is what we often recommend sort of for the next level system. The jump in price can be pretty significant. So a lot of times companies will sort of try to make it with a QuickBooks to start and then evolve to NetSuite over time. Having said that, NetSuite has been starting to make a pretty big play at startups. And I know I've been hearing that they're, I know we're getting some really significant discounts for startup companies. So it's still certainly not as cost effective as QuickBook, but it can make sense for startups depending on their situation to start looking at a more robust system like NetSuite, possibly earlier than was the case in the past. And then there are new players that are coming into the market. Puzzle's one of them that is a new player that's sort of looking to leverage AI and automation. We've had some clients that have had success with them, and so we're definitely keeping our eye on that as well, and worth a look. But like I said, when you look at sort of the real established player, QuickBooks Online is definitely sort of the go-to for most venture-backed startups.
What are your quick thoughts on Sage Intacct?
Sage Intacct is another system that some of our clients use. That I would say is sort of somewhat like NetSuite in terms of being next level, a little more expensive, but maybe a little step down from NetSuite in terms of the cost. I'm not personally as familiar with it. We definitely have some clients are on it, but it's not as broadly used as NetSuite, I would say. And then another system that startups look at is, particularly if you're using a QuickBooks Online, it's not as robust of a system. So if you're on a NetSuite or a Sage Intacct, you're going to have lots of modules that'll integrate stuff like accounts payable, expense management as part of that single system. QuickBooks Online doesn't have that. So with that, you're looking at doing add-on apps that are able to integrate with it. And to that end, actually, one thing I want to mention is that QuickBooks has an online version and a desktop version. The desktop is one that's supposedly been phasing out for 10 years now. It's still around, so I'm not sure where that's going, but it doesn't integrate as well with some of these outside apps. And because QuickBooks is not as robust as some of these later stage systems, you really, as a startup, want to be able to leverage automation as much as possible. And so because of that, you definitely want to be on QuickBooks Online and make sure that you're able to, leverage these apps that add on and integrate well into it. In terms of accounts payable and employee expense management, some of the systems that we work a lot with are Airbase, Ramp, Bill.com. Ramp in particular, I've worked a lot with. They do a great job of actually doing both employee expenses and accounts payable, and we're a big fan of this. And again, it does sync well with QuickBooks Online. They also have approval workflows, which we'll talk in a few pages about how important financial controls are, but these sort of integrate those controls so that you're actually making sure you have second sets of eyes on all transactions and make sure that you're sort of avoiding risk of any fraud or anything along those lines. And then another sort of system that early stage startups can look to put in place fairly early on would be cap table management. Carta and Pulley are two of our recommendations. Carta is sort of the one that's been around and very, really established. Pulley's a little newer, but definitely, people have been really happy with them. They're sort of a newer player and sort of have some good features, that type of thing. In addition to just managing the cap table, which is something that can help streamline some of your legal costs, you want to get away from having your law firm manage your cap table in Excel, because lawyers are very expensive. And so, every time you're contacting them for your cap table, start pumping out dollar signs, they're pricey. So if you can get it into a system, then yes, your law firm may be supporting the, getting everything set up, but then there's a self-service component that you're able to pull the cap table yourself without having to reach out to your lawyer, which is really effective. The other thing about services like Carta and Pulley is that they have your cap table and they're able to provide for you a 409A valuation. It's often included as part of the bundled price. A 409A valuation is a valuation that's required for startups to prepare in order for them to issue options to their employees. So the 409A valuation is what determines what the exercise price is on your options, and that's something that is sort of federal IRS tax compliant, because that's really important. And so the nice thing about a Carta or Pulley is that once you get your cap table set up in there, the steps you have to take to get the 409A valuation completed is very, very streamlined. This is something that, even 5 years ago, it would be, tremendous amount of work, a lot of back and forth with outside valuation providers. And at this point, I've put together sort of the inputs for a 409A valuation in a few hours with some of my clients. So it's just so much more streamlined and cost effective than it used to be. Any questions on this slide?
No, let's keep going.
Okay, so this next slide gets into some of the HR and payroll partners that we recommend for our clients. For companies that just have U.S. payroll, here's a list of some service providers that we recommend and that we work with quite a bit. I would say it's sort of I tried to sort of order this a little bit in sort of cost effective, ease of use, like at the top. So Gusto is sort of the most cost effective, and then moving down the line, Rippling, JustWorks, Sequoia, and Insperity. As you go down that list, their offering gets to be a little more robust, a little more expensive. And depending on sort of what your situation is, from a company growth standpoint, from the type of employees you have, where your employees are based, that might determine what makes the most sense. I will say that, all these services are great. Our clients work with all of them. I'd say Gusto is probably far and away the one that the largest number of our clients use, followed by Rippling as another very, very large one. But all can provide sort of really good services. Some of the things to consider when deciding which payroll provider to go with is understanding the profile of the employees you expect to hire over time. So if you're a company that if you're a company that's located in one location and all your employees are in that sort of one city, you're pretty straightforward and you expect to stay that way for a long time, Gusto's is probably going to be enough. If you're a company that's going to have a broader employee base, maybe remote first, employees in lots of different states, more complexity around employee filings, that's where you might be thinking about needing a more robust offering. And then the other factor there is that if you're expecting to be really, really high growth, systems like Rippling and some of the other ones are potentially able to sort of service you across the aggressive growth spectrum a little better than the lighter touch solutions. And then there's other features. So that, in terms of the robustness, there's better reporting capabilities, learning management, other add-on features that you get as you sort of move up the stream too. So, there's not a right or wrong, but you just got to do the trade-off between cost and sort of the type of requirements that you have. If you are a company that has international, either employees and or contractors, then you'll need to think about how to be able to service that. And in recent years, what's great is that, two companies in particular have done a great job with this, Deal and Rippling. And actually some of the other providers that I mentioned above in US are not yet really hitting on international yet, but they're planning to release offerings. So, and it's possible some are coming soon. So I think that there's going to be more and more of these payroll companies that are able to, ultimately be global providers for you. But Deal was sort of the first player that came in to sort of help support companies that are looking to hire employees internationally. And the challenge with having international employees is that technically the different countries where the domiciled in have various requirements in order for you to hire employees in that state. And it used to be that you had to actually, in order to hire an employee in India, you actually had to set up a whole subsidiary, which is very cost expensive. And then you have to get involved in all sort of complicated international tax arrangements and all sorts of stuff. So it would be the kind of thing that if you only had one or two employees in a particular location, it just wasn't cost effective to go through that whole process. With Deal, what they've created is this great sort of across, I think there are over 100 countries that they're in. They have what's called employee of record services, where they establish these presences in all those locations, and they're able to sort of act as the co-employer, co-hirer of these employees. So you're able to actually have employees scattered about not only across the US, in the current environment we've been in with remote first working, but also all around the world. And you're able to do that through a company like Deal with their EOR. Rippling also has an employee of record service as well. In addition to this employee of record service, if you are a company that has an international subsidiary, so you are actually set up with an established business there and have set up the tax arrangement and everything else, Rippling actually is not only able to do the employer of record, but they're also able to do the on-the-ground payroll. So I have a client that has a US parent company, a subsidiary in India. They use Rippling both in the US and in India for their payroll. And like I said, I think over time, more of these payroll companies will be doing that. But as of right now, if you're international, Rippling is sort of a really good option.
Debbie, quick question related to international workers. So do you suggest or recommend that a founder use an international payroll tool like Deal or Rippling, even for contractors that are international, not in full-time employees, contractors?
Yeah, absolutely. And Deal and Rippling both do international contractors as well. And the key thing there is that these folks help you manage compliance. So just like in the US, where there's all sorts of rules around what's required to consider someone a contractor versus an employee. And if you get that wrong, you can run into all sorts of tax consequences and other liabilities. Same thing can be true internationally. And so by working with a partner that understands all these local rules, they're navigating that for you and telling you sort of how does this employee needs to be categorized? How do you make sure you're following all the local compliance rules in terms of what you're doing? So, all these different countries have different requirements, just like in the US, where you have to pay payroll taxes, for example. In other countries, there's different requirements in terms of things that you have to pay into that are different from payroll taxes. Like we pay social security taxes in the US, they're sort of equivalent but different, depends on things in other countries, whether it's for employees or potentially even for contractors in terms of what's required. So having someone else navigate this for you is well worth it.
Great, thanks.
Yeah. And then another system, particularly if you're a company that's doing a lot of aggressive hiring, is you might want to think about putting in place a recruiting and applicant tracking system. Gusto and Rippling have one that's built into the system that's pretty good. Definitely a good starting point, probably good enough for most seed stage companies. But if you are really aggressively hiring, it may be time to put in place a more robust system and leverage the system that we found to be really effective for rapidly growing startups. Okay, moving on to banking partners. So banking partners have actually shifted a bit in the past few years since the SVB banking crisis. It used to be that, recommendation was, go work with a startup bank. They're the ones that, know how to work with startups that can focus on you and provide you the attention you need. But then when this SVB banking crisis happened, and there was a lot of these startups that were only banking with SVB and their cash was tied up and they were concerned that they weren't going to actually be able to make their payroll, there was a big sort of shift in approach of what's been recommended in terms of how to manage your cash. It's been a long time thing that like late stage companies that have a lot of cash have always sort of diversified across banking institutions so that they don't put all of their money in one bank account. But when you're a startup that has $1 million, $2 million, historically that wasn't felt to be necessary. Our recommendation on that front has changed. And what we are recommending at this point is that all of our startups have banking relationships with two different banks. Our recommendation is one of those be a startup focused bank and one be what you consider a major bank. Listed on this side, some of the possible recommendations. There's more banks than just this. So these are some of the ones that we come across a lot. But what I'd see on that front is that sort of in the immediate aftermath of the SVB crisis, we did see a lot of startups that were just trying to flee exclusively to the major banks. And our experience was that these major banks just aren't set up to provide enough focus that's needed for early stage startups. So, you have $1 million in the bank, you don't hit their radar. And so when you need some of the customer support and other things that are needed from your bank, you're just not going to get often that level of support. And so in that context, we are recommending that sort of you do the majority of your day-to-day banking with a startup bank, but then at the same time look at having an established account with a major bank. If God forbid something should happen with another crisis down the line, you have a bank account already established. You have the ability to move between bank accounts. In the midst of the SVB crisis, we had saw a lot of startups that were sort of last minute trying to open up bank accounts and transfer money really fast. And some of the early people who were sort of quick to move were able to, but then at some point everything got flooded and companies were locked up. And I saw one of my clients in particular didn't move fast enough and almost missed their payroll in the midst of everything. It all worked out in the end. FDIC insurance came in, but there was a really long weekend of significant concern that really never should have happened. And with this new practice in place of having more than one bank, you can avoid that level of risk. This next slide talks about, so the last slide was about like, where do you bank? This next slide is how do you think about holding your cash? And that was a key thing with the SVB debacle, was that what we saw was that there was a lot of startups that had money sitting in bank accounts that were only insured technically up to $250,000. And so the key learning from that is that you need to make sure your number one sort of goal is preservation of capital. So, you raise money from investors. That capital is meant to be used to drive growth in your business. Yes, there's some nice interest rates out there right now, and maybe you can get a little bit of, interest yield and help that to, pay for a headcount or some other expenses. But having said that, the number one goal with your cash is to make sure that you preserve it for its intended use and that you're able to access it, that you have the liquidity you need, that you're able to access it when you want it. Like I said, during that SVB crisis, startups had cash sitting at SVB, not able to access it, thought they were going to miss payroll, thought they were going to be subject to all sorts of penalties and, trying to get emergency loans from their investors. And it was a mess. So you need to make sure you preserve your cash and you need to make sure that you always have access to it. The third, and far at the bottom priority is to put that excess cash to work, benefit from interest rates. So yes, it is a good interest rate environment. I have many clients right now that are paying for a full head count with the interest they're earning for the year. So it's real cash. You don't want to discount the value of that. Having said that, I would always prefer a lower interest rate with safety on top of more interest, because that's, fundamentally you're not a bank yourself. You're not an investment company. You're a startup. This slide, the next on the right side, it highlights some of the low risk instruments. The key thing I'd say is that any cash that you have sitting in a bank, only keep cash up until the point that there's FDIC insurance. What you see now is that a lot of these banks, like after the debacle, have come up with products that are what's called insured cash sweep accounts. And what they're able to do is take your cash and actually sort of farm it out to multiple banks at once. So you're able to get the benefit of $250,000 FDIC insurance from multiple banks at time via these sweep accounts. That's a great product. Treasuries can be a good product too, although they don't have technically the insurance. It's backed by, the safety of the U.S. government, which hopefully is good enough. But the bottom line is, don't keep cash in any instrument, regardless of the interest rate you can benefit from. Don't keep cash in any instrument that, should there ever be a crisis again, that you'd be at risk of being able to access your cash. Okay. Next slide gets into financial controls. I know we're getting a little tight on time, so I'm going to start breezing through this a little bit. I know these slides are going to be shared. And the one thing I also want to mention is we'll share a link to Burkland's website. Also has sort of a detailed, what we call financial controls matrix, that gets into sort of some of these recommendations, but at a more granular level, how you think about putting in financial controls at different stages of your business. So we'll send out the link. It's a free download from our website, so please check it out. But at a high level, key thing to know about financial controls, the number one thing you want to make sure is that you have a segregation of duties. So anytime there's cash going out your business, you want two sets of eyes on it. So you want one person that's logging an invoice or bill, and the other person that's approving and hitting pay. And what that does is, there's all sorts of risks that you can face from a financial controls standpoint. These days, there's just a lot of scammers out there that are going to try to find ways to send you fake invoices from your law firm, somehow figure out who you're working with as a lawyer, send you a fake invoice with a different address, and get you to send them money. And by having two sets of eyes, that's two people looking at this to try to identify potential risks. So that's sort of the sort of core of financial controls, is making sure you have more than one person looking at it. The second part of it is approval processes. So having system-based tools that ensure you enable that segregation of duties, that you're sort of having one person review, one person input, another person review, making sure you're having the appropriate level of approvals and controls there. And then there's, from a banking standpoint, there's various things that you can do with your banks to make sure that they're set up to enable these approval processes, as well as financial systems. So like I mentioned on the prior pages, when it comes to accounts payable management and employee expenses, system like Ramp have these inboard approval processes that sort of do the same things that banks have within their systems before you're sending cash out the door. And then the last line of control is making sure that you review your financial statements. So, great thing if you take my recommendation, put an accountant in place from the very beginning. That's really critical. But then you also have to be reviewing your financial statements. You should be closing your books every month, and you should be reviewing your performance, and you should be looking at trend lines of expense. And if things are bumping up or down, make sure you're digging into it, understanding what's driving that. Was that expected? If it's not, dig into those expenses. You can just, by looking at trends or by looking at your performance against a plan that you put in place, that's a good way to sort of suss out if there's something that's out of the ordinary that's showing up. So that leads us into financial reporting. So, typically speaking, financial reporting, it is something that, I think from day one, you should be closing your books every month and pulling together financial reports and reviewing it yourself. And that's a good financial control, and understanding how you're spending your money and getting a good visibility to what your runway is at an early stage. But having said that, there's also investor expectations around financial reporting. And a lot of times after you raise your first round of outside capital, they're going to start expecting to have some level of financial reporting. So as a best practice, we recommend closing your books every month within 10 business days, putting in place a standard, what's called chart of accounts, which is the way you classify your expenses, and making sure that that's set up in a way that enables you to have your desired level of financial reporting, so that you're able to separate, how much are you spending on sales and marketing? How much are you spending on your research and development efforts? That you're able to break those expenses out and understanding sort of your core business drivers, which is something that your investors are going to want to understand as you scale your business. Ideally, you want to start putting in place a standard financial practice, a package, which, if you are at the point that you're having board meetings, that's something that you want to be sharing regularly with your board and or with your investors. And ideally, the financial reports would include stuff like your income statement and your balance sheet. This is information that should pull directly out of your accounting system, QuickBooks, or whatever you're using. If you have a financial plan, you want to be looking at how's your performance coming in against what you planned. And then as the business starts scaling, you're starting to look at reporting, also including some of your other KPIs, like if you're a SaaS company, looking at your ARR and your churn and some of the other metrics like that. Periodically, investors may be requesting that you send them financial reports, and what you send them should be something that you can pull directly out of QuickBooks. It should be something that's just part of your regular process, no extra effort. You're closing your books, and then once those are closed, you're able to pull a report and easily send it to your investor. This next slide is about corporate tax. Key thing here is that it can be very, very costly if you don't get it right from the very beginning. So the reality is startups, they're not making money often, they're losing money. You're not going to have to pay income taxes yet. You do have to pay employee payroll taxes, but you're not actually writing a check when you're filing your annual taxes. But if you don't file those taxes, you will be writing a check because you'll be subject to penalties. So the key thing there is just making sure you're compliant with all your filings and doing them in a timely manner. This slide lays out some of the tax deadlines. Just make sure you have a tax professional that's able to guide you through all the different requirements and make sure you're submitting things in a timely manner. Something that sort of popped up over the past several years is if you have foreign activities, whether it's a subsidiary in a foreign market or outside investors, there's new requirements for reporting of these foreign activities. Really critical, really, really significant penalties if you don't make that. So make sure you just have someone that knows how to make these filings and do it on time. Other key things to keep in mind, there are R&D payroll tax credits that even though you're not paying income tax yet, you are paying payroll taxes. And so, about 5-10 years ago, they established a R&D credit that can actually be applied against your payroll taxes. So what happens is you can actually get refunds after the fact on amounts paid on payroll taxes in exchange for the R&D efforts that you've invested in as a business. Other key thing to look at is sales tax compliance, making sure you're compliant from the very beginning. And again, that's another area that if you don't do it right from the very start and you get audited, you can end up having really, really substantial penalties. Sales tax is something that you should be charging to your customer and then remitting to the government. But what happens is if you don't charge your customer and then you get sort of caught for not doing appropriate sales taxes, you're subject to that tax, whether or not you can go back to your customer after the fact and collect on it, which chances are more likely than not, if you didn't collect it initially, you're never going to collect it. So you're just fundamentally subject to something that your customer should have paid for. And here's last slide is about due diligence prep. And the key thing here is this just sort of gives some details. I'm not going to go through all of these, but it gives the idea of some of the files that you might want to start creating a file structure and saving sort of key documents into these files. And what that'll do is that when it comes time to raise your next round to look at various deals that you might have outside diligence for, you want to have this organized, because I can't tell you how many times I've seen startups in major fire drill situations that they're needing to raise capital, trying to close it fast, and then they're not able to find all the documents they need. And it creates a lot of mishaps. So try to stay as organized as you can from the very beginning. And last slide is just sort of key takeaways, but nuts and bolts of everything we just went through. First of all, make sure you hire experienced accounting support from the real start. Get finance systems and payroll that are cost effective, easy to use. Automate your processes. 2 bank accounts like we talked about. Make sure you're putting in financial controls from the very beginning. So that requires the 2 sets of eyes, which is where having outsourced support can be sort of that one of those 2 sets of eyes. And then certainly making sure that you're compliant with taxes as well.
Awesome. We don't have much time left, so I'm going to just knock out 2 questions from the audience that we didn't get to address. And apologies for those of you that are still with us if we didn't get to your questions. We'll provide Debbie's contact information at the final slide. Okay, first question. So if a founder, let's just say pre-Series A, or sorry, pre-seed even, the founder is handling all the bookkeeping themselves, what are some best practices that you would leave with them if they're going to do it themselves for a period of time?
Yeah, I would go with, setting up, probably QuickBooks is a good system to use. It's fairly user friendly. Making sure that you establish a really solid chart of accounts. So that's basically how you categorize the expenses. And depending on your industry, you can probably do some searches online on sort of best practices for charts of accounts for SaaS companies or something like that. So try to leverage some of the best practices that are out there in terms of how to establish the chart of accounts. and making sure that all your documentation on expenses is really well organized. Because if, in case you aren't doing it exactly correctly from an accounting standpoint, and someone's going to need to come in and sort of clean it up after the fact, you just want to have really good organization of your files so that it's easy for someone to come in and sort of review and make sure that things were done correctly. So again, if you have an accounting background, no problem. But if you're not an accountant, I'm just telling you that more likely than not, if you do it yourself, it's going to have to be cleaned up, because there's just some nuances to accounting that, and I'm a CFO. I don't do the bookkeeping myself either. So I would bring in a bookkeeper. If I were to start a startup, I would bring in a bookkeeper. I wouldn't do it myself either. So it just is a best practice. But if you are going to do it, just try to make it so that just as organized as possible. So that should, and maybe you'll get it right and that'll be great. And if not, just have it organized so that if someone's coming in later and doing the cleanup, that it's a streamlined process.
Great. Okay. One final question. If we could keep it fairly quick, then we'll wrap up with the next steps. So someone had to ask about startup banks versus the major banks. What are the key differences? What's the benefit of using a startup bank versus a major bank?
Yeah, I think one of the key things, if you'd asked me this a few years ago, I would have sort of leaned to talk a little bit about like venture debt as one of the things. So a lot of these startup banks have venture debt practices that are aimed at startups. So you sort of start your relationship early, and then that sort of helps lead to a potential venture debt round should you need to get there. And that's still potentially true, although the venture debt market's a little bit sort of uncertain in terms of where that's going to head. But after the SVB experience, where I worked with a number of startups on getting set up at the larger banks, my experience and a lot of my colleagues' experience also was just the customer service levels for startups just wasn't good enough. So I had clients that needed to get, various documentation things set up, and it would take forever. And I think what it came down to it is that the level of funds that they had in the bank account didn't raised to the getting sort of the premier level of customer service. And so you were sort of relegated to calling into the 800 line, or just having people that had very large caseloads, and it just wasn't responsive enough, and created some issues, frankly. So I just think that startup banks are fundamentally more set up to focus on and work with startups. And then they have other benefits, like a lot of times the startup banks will have things like discounts and other things like that they can offer to clients too, and various resources and stuff like that that are beneficial as well.
Awesome.
Yeah.
Okay. Debbie, thank you so much for spending time with us. Thank you so much. We'll see you at the next session. Take care, everyone. Bye.
Everyone.